apparently soggy Seattle today, right, Mark?
It is definitely soggy here, and like I've said a few times, having both of those certifications just means I'm truly certifiable.
Very good.
But you got to have fun with it, right? So,
You got to have fun. All right, just a couple of logistical items before we get going. You can send in your questions in the Q&A functionality underneath the presentation window. Your questions are private, will only be seen by Mark and myself. We'll keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We also have our usual written disclosures we are required to show. Everything Mark and I talk about should be considered as educational and informational in nature only, not should be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, but we do not recommend the use of technical analysis as your sole method of investment research. We look at the ETFs and ETNs to evaluate markets and sectors, but if you're going to trade those products, read a prospectus. We also look at futures contracts if you're going to trade those. To take the time to read the risk disclosure document for futures and options. And with that, I'll put up the heat map, review what I see for news today, and Mark, if I miss anything, just chime in. All right, overseas, Chinese economic data was a little bit disappointing as industrial production missed estimates. They were looking for a 5% increase, came in at 4.4. Retail sales were also a little weaker than expected. The estimates were for a decline of 2.3%, came in at 2.8% negative. Fixed asset investment also missed expectations. The Asian markets went down quite strongly on virus second wave fears, if you will. Japan was down 3.5%. Hong Kong was down 2.2%. Shanghai was down 1%. India is down 1.6%. As I said, at least overnight, the market was focusing on the second wave narrative as Beijing, China reinstated some coronavirus measures. They had an unexpected spike of cases linked to the city's wholesale food market. After 2 months with no infections, Chinese officials reported 79 cases over the past 4 days. And so now they're setting up security checkpoints and they're closing schools and they begin mass testings on Sunday. Also, Tokyo had reported a substantial jump in cases over the weekend. So we were worried about that earlier. 4 hours later, we're not worried about it anymore, it looks like, in the markets. Anyway,
funny how quickly things change.
yeah, in the U.S., again, there is the second wave narrative floating around. Alabama, California, North Carolina, Oklahoma, and Texas reported sharp increases in daily new cases over the last few days. Now, some of that, of course, is due to more testing. So what I've been saying is maybe you want to keep your eyes on hospitalizations, which are going up in North Carolina and Texas right now. In domestic economic news, we had the New York State Empire survey. It was negative 0.2, but that was much better than the consensus, which was negative 25. Remember, in May, that was negative 48.5. Remember, on this survey, 0 is the dividing line between expansion and contraction. Anyway, so all it's really showing is a big jump from April and May, which you probably would expect, but at least it's going in the right direction. Anything else you want to point out in the main news there before we move on to?
No, just we'll talk more about the intermarket aspects of what's going on later today. But no, we're good now.
All righty, let's. Gold still in the trading range. We're looking at the August future here. There is your support right around there. It's about 1675-ish. So we're in a trading range. You could trade it as a range. Right now we're kind of in the middle. The risk to reward isn't particularly good one way or the other, although maybe short-term traders would use right under the 50-day moving average if you think it's going to go up and hit the top of the range to get a better risk to reward. But basically, we have a trading range on these. Let's just take a look.
Lee,
Yeah, go ahead.
that kind of purple moving average, is that the 20?
That's the 50.
That's the
Yeah.
50. Okay.
Let
Let me make a point on that because, you know, when you have the 20 and or the 50-day moving average, that is pancake flat. If you haven't figured out it's a trading range, that's definitely confirmation. For those who want to trade in a range-bound environment, that's where you're trying to buy the low, sell the high. But you've got to, something we'll talk about a lot more later, very clearly manage risk. For trend traders trying to trade something like this, you're just going to get chopped up. You think it's a breakout? No, it's a fake out. Going up? No, going down. Going up? Going down. So for trend traders, these are not exactly great markets. For range-bound traders, this is your cup of tea.
That's right. And typically, instead of using moving averages, as Mark has written in many articles, you would use oscillating type indicators like stochastics or RSI or something like that to help time your trades near the bottom of the range or the top. All right. Let's take a look at, we want to look at copper.
Dr. Copper.
Well, it has confirmed what went on with the equity market.
Mm-hmm.
The 200-day is kind of giving support here. It is flat though.
That's actually a positive from, if you look back a month or two, it was actually had a slight negative slope.
Yeah, so it's improving.
Yeah, it's flattening out. And now that we've got a sharply, well, I won't say sharply, but a rising 50-day, gee, what's going to happen in a few weeks, Lee? The Golden Cross.
Yep. The good news here is that we aren't getting any divergence anyway between the copper price and the market, which is kind of what we look for here. Someone wants to see the copper miners, or this is actually the copper ETF. It looks exactly the same. Holding the 200-day, that would be your support level. If you wanted to trade it on the long side. On the on the short side, maybe wait for a break of the 200 with a stop above the high of last week. Let's take a look at oil. Okay. I always check that just to make sure I'm not missing the front month. It's still July. Pull back to support is really all it did.
Yep.
So
Still nothing broken here.
Yeah, nothing broken here. Exactly right. Like Mark, good way to put it. We still have higher highs and higher lows. Technical analysis 101.
And we actually won't have a lower low until price breaks down around where the 50 is right now, beneath the late May lows.
Right. So again, just from the charting perspective, the path of least resistance seems to be with the bulls. All right, let's take a look at bonds. So are we going to get whipsawed on our bond signal or not? Let's take a look. This is the TLT, the long bond ETF. And we did get the cross here, which is what we look for on this one, which closed out the trade with our buy at 138. Again, these are recommendations, just observations. Change here at 162. Right now, we haven't crossed back. So again, that would suggest caution on the long side here on TLT, but we shall see. Again, you can get whipsawed like we did in here, but then you get these huge winners. That's kind of the way it works with trend following, right, Mark?
Correct. Again, we're going to talk more about that later.
Yep. All right. Let's just take a look at the 10-year yield. Put that up here. So it's kind of range bound. It looked like a false breakout there. Back into the range. All right. Let's put up the
Steelers wheel market stuck in the middle with you.
There you go.
And only older guys like us will get that one.
Yep. All right, I'm going to put up the S&P, trying to hold there at the 200-day moving average key level here. I'm going to give you some fundamental values here in a second, but there's pretty good support right around the 50-day to 29.50. It's interesting if we put up the futures. Mark and I were just talking about this. I mean, we were down overnight. You can see where we were. We were down. Yeah, we were down what 100 S&P points.
I don't know if it was that far, Lee, but
99 or something. Yeah, it was
it's pretty darn close.
Yeah, you can see we've rallied since. If you like to do this intraday, we always keep our eye on the 20-period exponential moving average on 5-minute charts. You can see it. Gee, does anybody else look at that? I don't know, but gee, that's where it stops. So anyway, right now the intraday trend is now up. And if you are day trading, your first, if you want to take a little profits, R3 is right up there at 30.51. But keep some and just watch that 20-period exponential moving average. I'm going to put up the index itself, give you some valuations, but then I'm going to turn it over to Mark, who wants to talk about what you should do, risk versus reward, and a couple interesting tidbits. So let me just start here. Number one, with the commitment of traders report. Smart money hedgers, you want to call them that, they didn't really go to more extremes. They did reduce their long positions in these equity futures, but they are still long more than 37 billion worth of contracts, which is still a positive outlook, at least from them. The only other, they are buying agricultural contracts. I just point out that they hit a 23-year high in net contracts long on corn, if you have any interest. All right, let me just give you some valuations here. So, number one, these valuations are based on earnings estimates, and you can say, well, maybe it doesn't mean so much because a lot of companies have pulled their guidance. So with that caveat in mind, I just thought I would give you what the analysts are looking for so you can do your own type of PE analysis, okay? So the mean estimate for 2020, but remember, the market is not trading on 2020 earnings. It's trading on 2021 earnings. But the mean estimates for 2020 for a share of the S&P is 127. The mean estimates for 2021 is 163. And now when we look at the forward PE, you can either look at the forward PE on 2021 earnings, or you look at the forward PE for the next 12 months, which would be Q3, Q4, Q1, and Q2 of next year. If you do that, it is at the forward PE, if you use the next 4 quarters, is 21. And for what it's worth, that is, of course, above the 10-year average of 15.1 and above the 5-year average of 15.6, I think. So, even based on those estimates, the PE is relatively high. True interest rates are really close to zero, so that makes PEs go higher, but for what it's worth, that is the valuation on the market right now.
Hey, and Lee, something you alluded to in kind of a preface to that segment was many companies have pulled their guidance, and therefore, fundamental valuation may not be as, for lack of a better word, let's say robust as normal. And Lisanne Saunders has made the point actually very early on in the COVID crisis that, nobody has a model for what happens when you shut down entire cities, entire states. sectors of the economy. There have been something like 288 companies that have cut or reduced their dividend already this year, and 166 of those have completely eliminated their dividend. That's as of a week ago. Perhaps one of the most shocking, not that I should say unexpected given the industry, but Royal Dutch Shell. And they had not reduced their dividend since World War II. So that gives you an impact of how this environment is certainly different from others. I don't mean to imply this time is different, but this time we're looking at fundamentals without the benefit of the traditional earnings modeling that analysts do.
Yeah, and if you want more insight from Lizanne, we should mention that she is doing Lizanne live today at 4:30 Eastern.
And Ying in California has a question: why the real rates have effect on forward PE? The short answer is that it has to do with the time value of money. I would contend, and it's totally personal opinion, the bigger picture is as competition for investing in stocks. The yield on the S&P 500 is probably a little below or just above 2% right now. And as we looked at earlier, the 30-year Treasury right now will pay you 0.7%. So in terms of competition for investing dollars, bonds in a low interest rate regime are not the solid competition that you would expect from stocks.
All right, so you've got some interesting concepts about trying to manage risk in this type of market. So I'm going to turn it over to you now.
Thanks, Lee. And I'll tell you, and those of us who've been in the industry for a while, you see different types of speculative bubbles over time, the dot-com bubble, and then many others. But the dot-com in our environment, in our lifetime, is probably the biggest example of that. When you see companies that have filed bankruptcy, like the poster child for this is Hertz. And in a bankruptcy, the common stock shareholders are, with very, very rare exceptions, totally wiped out. And yet when you see a company that's in bankruptcy go from under $2 a share to over $6 a share in 3 days, that is speculative fever. A lot of the other troubled companies, the COVID companies, airlines, hotels, a car rental company besides Kurtz or Avis Budget, those really fundamentally troubled issues have had just spectacular rallies. So in this kind of an environment, and Randy Frederick has tweeted a couple of times in the last few days, if you follow him on Twitter, that for those who don't have a lot of capital and don't have a lot of experience in the markets, do not trade these fundamentally troubled companies. So if you would, pop up that graphic that we talked about, Lee. And this comes from an article I wrote a while back called Why It May Pay to Sell Even at a Loss. And there are several types of fear. In fact, I'll break it down to contend there are 4 types of fear, one of which sounds a lot like greed, and that is the fear of missing out, or FOMO. FOMO comes into play when you just have to jump into a trade. I've got to get into this now, and I got to catch it before it gets away from me. If you ever catch yourself saying that, take your hands off the mouse, because greed is working its magic on you, or it's evil on you. The second one is the fear of losing money. That one's obvious. The third one is the fear of leaving money on the table. And this leads to something that we refer to as the endowment effect. And once you've seen what the endowment effect means is, for instance, if you saw the S&P 500 trade at 330, and now we're back down around 300. Well, fear of leaving money on the table, you've seen the market trade at 330. And mentally, at least subconsciously, we think we are, by God, entitled to 330, and I'm not going to sell for any less. So that's the fear of leaving money on the table. But what Lee has highlighted here is, to me, one of the biggest problems that individual investors and many professional traders face, and that's the fear of being wrong. Put it this way, the overwhelming desire to be right. Now, if you are a product of the school system, you can fall prey to this, because if you want to pass the class, you've got to be right 70% of the time. If you want to get an A, you got to be right 94% of the time. But when we go through this process of finding a company, screening, of blending both fundamental and technical analysis to decide whether we want to actually add this to our portfolio, research. When our finger hits the enter button to buy that stock, we're no longer just investing our capital, ladies and gentlemen. We're investing our intellect, and we're investing our ego. Okay? And we don't want to be wrong. So scroll up and scroll down a little bit until you can see the entire formula there. This is something I learned probably now 17 years ago. And it's a formula that I use literally every week to evaluate the competence of my trading. And it's a very simple formula: total profits divided by total losses. And Lee, this is the Captain Obvious moment. We want profits to be bigger than losses. So what this means is, or what this measures rather, is absolute return. Did I make money? Did I lose money? Or put differently, since the first of Schwab's investing principles is to begin with a plan, hey, am I moving closer to achieving the goals I've defined in my financial plan? Or am I moving farther away? And as you can see, that formula has two components, but the one in the middle, the number of wins and the number of losses, that's what most individual investors get hung up on. When I go through this process, screening, research, execution, I decide I'm bullish, I buy some. If it went up, I was right. If it went down, I was wrong. And this bleeds into the worst examples of greed and fear. I talked about that earlier on in this article, but we'll just stay there for now. Greed is actually what gets us to hold on to a losing trade, because there's this voice that whispers in our ear, if you don't sell, it can come back to even and you won't be wrong. But most people who've suffered a portfolio crushing loss made that mistake, that when it was a small and manageable loss, they didn't want to cut it. But on the other side of the equation, when you see something rise from where you bought it and then start to pull back, believe it or not, this is actually fear that kicks in, and we want to grab those profits before they slip away so that we can put the check mark in the I was right column. So this actually doesn't mean anywhere near as much as most people think. In fact, I've seen studies done with professional commodities traders where give them a large enough sample size, an example, 100 trades, but they're and by the way, commodities, because they can go long or short with equal ease. That's important, because the entry was random. Flip a coin, heads you're long, tails you're short. So with a totally random entry, because they were professional traders, they would show a profit after 100 trades, because they focused on the second set of criteria over there. How much money do I lose when I am wrong? How disciplined am I at cutting my losses short? On the top side, how much money do I make on average when I win? How disciplined am I at letting my profits run? So this is the area that I would encourage individual investors to focus much more of their attention on. How much money is my average win? How big is my average loss? And if you only focused on one of these, ladies and gentlemen, professional traders focus on keeping losses small. And as you see down there at the bottom of the page, if there's a golden rule of trading, it is these 6 words, actually 8. Cut losses short, let your profits run. Far easier to say than to do. So now let's pause and take a couple of questions. So Yeah, Christina in Florida, Chesapeake. Yeah, you could find a lot of companies that have either filed bankruptcy or are rumored to be filing bankruptcy, companies that have cut or omitted their dividend. All of those fall into that category of the fundamentally troubled companies. Uh, Ann in Alabama has a couple of questions. What does doubling down mean? You want to be right more? Question mark. And the answer is, yeah. Whenever we do this, we're adding to a losing trade, and that is rarely a good idea for a short to intermediate term trader. It can be a good idea for a long-term investor, particularly if that is part of your plan, and you're building a position in the stock with in essence, a dollar cost averaging type approach, where you're putting a relatively fixed amount of money to work over periods of time, every week, every month, whatever. Or as you develop your plan for a given trade, hey, I'm going to take a starter position at 50. If it pulls back to 45, I'm going to add some. If it rallies to 55, I'm going to add some. If it's the bottom line, doubling down, if that ever works for you, the market is teaching you a bad lesson that ultimately will cost you a lot of money. And then also, but if you didn't sell in March, it did recover. And yes, you can always find examples of that. The key point, ladies and gentlemen, is we have to play the hand we're dealt. We have to make decisions based on the information we have right here, right now. And we talk a lot in Charting the Markets about technical analysis. The trend is your friend until the end when it bends. And trend traders tend to do very well with this kind of a strategy because they're going to have a lot of losses, but they're small losses. They'll have a few wins, but typically, as Lee was pointing out as we were looking at the bond trade, those wins pay for a lot of those little losses. Many professional traders have win-loss ratios at or below 50%, but they're very profitable because they focus on cutting losses short. So let me pause there. And Lee, you've got a lot of experience in this arena. What would you add to this?
Yeah, I mean, I think what happens is you have to, like you said, have a plan. And I don't usually average down in positions, except it depends on how you define that. If I buy something because it's moving, it looks like it's breaking out, I'll take a little. If it pulls back to a place where buying should come in, like a support level, I would consider adding money there, even though it's a lower price than my first trade, because it just pulled back to a support, and I was thinking in my plan that could happen. What people do, though, is it breaks support. We're talking about short and intermediate term trading, like Mark said. If it breaks support, that's when, if you add to it, now you are going back into hoping it comes back. So you got to define what you mean by kind of averaging in. You can buy at lower prices, okay, as long as it's at support and you had said in advance that's what you were going to do. So anyway, so Mark, where do they find this article? I just pulled it up because you gave me the link. But how do I get to it?
Actually, you could go to a new browser window. And believe it or not, Lee, I actually have my own Schwab page, www.schwab.com/Mark item, all one word.
Okay, let's see if I can do that.
And the last name is spelled E as in Edward, I, D as in David, E as in Edward, M as in Mark. When you pull that up, there's my bio and background, and then there are the 3 most recent articles I've written for Schwab. And the one we're looking at is why it may pay to sell even at a loss. That and then the hidden costs of managing your own money. Those are the first 2 in what ultimately will be a 4-part series on developing a sell discipline. The third article has already been written. It's in the approval process now. I'm not sure when it will come out. It's certainly been delayed due to COVID. But that is a sell discipline for dividend-oriented stocks. And another veteran of Schwab Live Daily, Adam Lynch, and one of his colleagues helped me as co-authors on that. The fourth one will be 6 things to consider for short and intermediate term traders to put into a sell discipline. And let's see, David in Oregon asked, what's a swing trader and how is it different than a trend trader? And these refer to time frames. From a long-term investor, in fact, if you'd go back to Street Smart Edge and go to a chart of SPY, and then pull up a weekly chart, long-term core holdings, we want to base on longer-term trends and look back, say, 10 years or so. Okay. And those are some great examples of long-term trends. When those trends are in force, they literally last for months to even years. So an intermediate term, or what we would call a position trader, they will make decisions based on daily charts. So flip to the daily and maybe go back 3 years. A few weeks to a few months. Go back a couple, 3 years there.
Yeah, I did. That's 3 years.
Oh, okay. We got to be on the daily. I'm sorry. I think you're looking at weekly there.
There you go.
That looks like daily.
Yeah, it's
Oh,
daily.
okay.
That's 2018 in here.
Oh, there we go.
Yep.
Okay. So these trends don't last as long and they change much more frequently. Swing traders want to hold things for a few days to a few weeks, and they can base on daily charts as well with a much shorter time frame. But generally, we're more focused on hourly charts or even other intraday. And then, of course, intraday traders, you're trying to close positions out in the same day. You're holding them for a few minutes to a few hours. So those are the different time frames. And Jim in Maryland asked, respell my name. It's item, which begins with an E. So it's E as in Edward, I as in India, D as in Delta, E as in Edward, M as in Mark. So those are the different time frames, at least the way I'd define them. Lee, do you have any variations on that theme?
No, but just a rule of thumb that some traders use is, if you're doing moving average analysis, what moving averages should you look at? And generally, if you like to hold a stock X amount of time to try to figure out the trend that might make a difference for your trading in that time frame, look what's going on maybe 2 times X, something like that,
Mhm.
to try to get that. Because I mean, obviously, if you're a swing trader, the 10-year trend doesn't mean anything to you, and so just look back maybe twice your anticipated holding time to see what the trend is in that time frame. Some people use 2, some people use 3, some people use 2.5, but somewhere in that ballpark. So for instance, swing traders like to hold for a week or 2. They tend to look at the 20-day moving average. That's twice 2 weeks.
Mhm.
So I think, and that's what you can. If you're a position trader, you like to hold for a month, well, then maybe you look at the 50-day moving average, which is 10 weeks, which is like 2.5 months. So again, that's why people look at those different moving averages.
Right. And one thing I'd add to that is there's no, quote, right or wrong, unquote, way to approach the markets. One of the things that's incumbent on each of us to do is to develop a trading methodology that makes sense for us. How much time do we have available to pursue the markets? What's our risk tolerance? Are we rather risk averse, or are we more tolerant of bigger losses, but we want bigger returns? No right or wrong way to do it.
All right. Let's just take a look at some more markets. That was excellent, Mark. Thank you very much. Let's take a look at we already looked at the S&P. Let's look at the NASDAQ 100. Let's look at cubes here. Zoom in. And there. So again, now the 20-day, if you are kind of a short to intermediate term trader, something you might want to keep an eye on. So we're right there. It looks like we held it today. If you want to join the trend, maybe you put a stop under the low of today and Friday's low, which is right also under the 20-day moving average. But again, just technical analysis 101, higher highs and higher lows, I think.
Mhm. The only
So,
thing that looks a little concerning about this now, and if you zoom into just like 3 months,
okay.
we had a breakout to new all-time highs, and as of this moment, that breakout is a fake out. Now, I'm not going to get too concerned unless we take out Friday's lows, but things that break out should pull back, or quite often do pull back to the quote scene of the crime unquote, where they broke out from. Former resistance becomes support. That is very, very common.
And that's what's happening now too, right there.
Yeah, right now we're right back at that support level after breaking below it briefly on Thursday and Friday.
Yeah, we got a question. Is there a way to trade the NASDAQ 100, the NDX? Well, yeah, the Q is the ETF for that, which tracks it. And then there is the NASDAQ 100 futures, the NQ. So they are the way you trade that index, either one. It depends though if you want the equal weighted one versus the market cap. So the futures is the market cap, the QQQs are the market cap, the equal weighted NASDAQ 100, you do the QQQEs. Now this one has broken out and did hold the breakout level. So this looks a little different than the market cap weighted just for a little bit. You can see the difference where it broke out also, but failed to hold it. All right, let's take a look at the Russell, and then we'll look at the industry action today real quick.
While you're talking about that, I'm pulling up the weighting on the NASDAQ 100 to illustrate how important that is.
Yeah. So this is kind of interesting. It broke out last week. It went down back through the breakout level, which, as Mark said, you didn't really want to see that. But today, looks like maybe we're having a bullish engulfing candle. But we're still at the 20, but at least we're back above the breakout level. So
yeah, that's definitely a bullish engulfing. It dropped down below not just Friday, but Thursday's lows. Friday was what we would call an inside day.
Right.
And that it was both the low and the high were contained inside of the previous day's range. So now we have a bullish outside or engulfing day where today's low, in fact, really today's low is pretty much the market open. And in fact, it was the market open. We've rallied pretty much straight up since then.
Yeah, we got a question. Most of our commentary are about 1 day to several months trading. That is correct. Schwab have a weekly webinar focused on long-term investments and investors. You can listen to Liz Ann live. She is the macro person, and also Modern Wealth Strategies. That's on Fridays generally, and they take the longer-term, asset allocation view and all of that. So yeah, that's pretty much on Fridays.
And additionally, you can apply everything that we talk about in, let's say, a daily time frame, trend analysis. Those things hold true on weekly charts, and that is the preferred time frame for longer term investors. So any of the techniques that we talk about, any of the things we mentioned in terms of following a trend, trading a range, support and resistance, those things apply equally to the longer term weekly charts.
Excellent point. All right, let's take a quick peek at industry action today.
Actually, before we do that, let me talk about the weighting versus, because you made a big point about the equal weight NASDAQ 100 versus the QQQ, which is the cap weighted. The reason that makes a difference is the NASDAQ 100 is 100 stocks. The top 10 holdings represent 54%. Apple alone represents 12%, Microsoft 11, Amazon 10. The two forms of Google represent 8, Facebook 4.5. So just the 1, 2, 3, 4, the top 4 holdings represent almost 40% of the index weight. Whereas the QQQE, each company in the index has a 1% weighting equal. It's a big difference in the cap weighted indexes.
Good point. All right. Let's take a look at industry action. All right, looks like biotech is moving again. You can see all the biotech type stocks, genomics, biotech, cancer. Let's take a look at the biotech stocks. They broke out and are now bouncing off the breakout level. So the XBI is pretty easy to set your risk on this one.
And notice even at the close on Friday, it had kind of peekabooed below that level, but closed above it. So there's a sign of relative strength versus the rest of the markets.
Yeah, that's correct because yeah, that's a good point. Let's take a look at the big ones, the higher cap biotech stocks. It's so they did not hold their breakout level. However, they did, you'd have to say, test and hold the 50-day moving average.
Mhm.
So I think that's what you might want to use to manage your risk if you want to go long on this one, versus I think I would use on the smaller biotechs. Probably you'd want to use you could use the 50 there too. You could use Friday's low. You could use where the blue line is. Depends on how much you want to risk. All right, let's see what else is moving. The cloud computing stocks are moving again. Looks like they held the 20-day moving average. Could be, again,
Another sign of relative strength.
that's right. That's right. And we could take a look at how it's doing versus, let's take a look at how the relative strength versus the market on these. You do that with our price relative study, everybody. You just put in what you want to compare something to. S&P. You can see pretty much the cloud computing stocks ever since the low, because it's part of the stay-at-home type thing, okay, has been outperforming. That is an uptrend for sure. All right. See what else is moving here. So we've been monitoring the home builders. They're still in their channel. As a matter of fact, it looks like they might have just pulled back to kind of the lower portion of the channel in here. So I think some traders would say, look at the trend line on this one.
Trendline support.
Trend line support, bounced right off of it. And now you're back above the 20. You know, you gapped down below it, but took it right back. So again, just from a technical analysis 101, it's still higher highs and higher lows on big pullbacks. Okay, what else we got here? Let's take a look at, yeah, the gold miners are doing a little bit better. Let's take a look at those. They were kind of range bound though, yeah. It's kind of like gold.
Very much so.
They're just range bound. Key level on here would be 31 on the downside. And we'll do one last thing. Somebody wants to, Robert in Connecticut looks at the price relative of the equal weight QQQs to the market weight. Let's do that, show you how to do it. So we'll put in the equal weighted at the top, QQQE, and we will compare it to the QQQs. So what I find interesting is, notice when the market pulled off hard, how they underperformed. And the reason for that is that they go right back when they're worried, they go back to the mega cap technology stocks as a defensive play.
Mhm.
And that's what you're seeing there. It used to be a rotation into those guys was considered really bullish for the market because they were growth stocks and all that. But lately, and I mentioned this on Trader Talk too, lately it seems that those are almost the defensive play now, where you want a little exposure but not too much risk. They just rent
Mhm.
those stocks for a little while, institutions. So
Yeah.
anyway,
Hey, Lee, can I add like 1 minute for a quote? I was looking for this and I've been
sure.
reading the classic by Bill O'Neill, How to Make Money in Stocks. And this goes back to the point earlier. He has a section in here on page 298, avoid penny stocks and low price securities. Quote, I strongly advise you to avoid gambling in such cheap merchandise because everything sells for what it's worth. You get what you pay for. These seemingly cheap securities are unduly speculative and extremely low in quality. The risk is much higher with them than with better quality, higher priced investments. I prefer not to buy any common stock that sells below $15 per share. Our extensive historical studies of 125 years of America's super winners show that most of them broke out of chart bases between 30 and 50 a share. I can't say it any better than that. If you're trading in the fundamentally troubled companies with low prices, you're playing with dynamite. Be very, very careful and run for the hills at the first sign of a loss.
Outstanding advice, Mark. Thank you very much. Coming up next, they're not giving me a break today. I'll be right back with Fibonacci tools. As we mentioned earlier, again, from a more macro investing standpoint, you might want to tune into Liz Ann Live. Liz Ann Saunders is our chief market strategist. Will be with my boss, Joe Mazzola. And then, as we talked about Modern Wealth Strategies, will be next Friday, the 6/26 at 2 p.m., where they'll talk about financial planning and the benefits of planning. So stay tuned for all of that.
Take care, everyone.
Thanks. Bounced a trade idea off my firm. They don't get it.
Schwab shows you indicators, proprietary